Hello, everyone. My name's Samantha. I'm a senior manager out of Thornton here in Australia. I'm based out of our Sydney office, and I'm very delighted to come and speak to you today about a lot of the very recent sustainability reporting developments that have been occurring internationally. We are quite a close-knit group today, so if you would like to ask any questions, please just unmute yourselves and interrupt me, and we can carry on. If you don't feel comfortable doing so, please drop it in the chat, and I'll see that there. So I just want to start with an acknowledgement of the traditional owners of the country in which I'm presenting from. So I'm currently out of our Sydney office, and I'd like to acknowledge the Gadigal people of the Eora Nation, who are the traditional owners of the land on which our Sydney office is based. We would like to recognise their continuing connections to the land, the water and community, and pay my respects to the elders past, present and emerging. So just to give you a sense of what we're going to be covering today, we were supposed to have John Ascombe, one of the partners from our CFO advisory team, presenting with me. He's unfortunately unwell and is unable to join us, but you've got me. We are part of the CFO advisory team here in Sydney at Thornton. What we do primarily is to help CFOs and C-suite executives with any significant accounting issues, transactions. But more recently, what we've been doing is helping a lot of companies prepare for potential mandatory sustainability reporting. And that may be reporting that's required by their stakeholders, reporting that's coming from changes to the regulatory environment, wherever their operations may be based, or just generally starting to get a handle of what might be coming down the pipeline. So I'm going to start briefly by covering ESG, and it's a topic that gets thrown around a lot, but really what we want to focus on is what it is and especially what it isn't. I'll briefly cover some of the recent developments around the formation of the ISSB, which is the International Sustainability Standards Board. I'll then briefly run through what the new standards, which were released on the 26th of June of this year, cover and which companies it's likely to impact, and give you a sense of kind of how this is being adopted across the globe, and leave you with some final thoughts about things you might want to consider. So starting with ESG, it's kind of received a lot of media attention, I guess we could say, in the last couple of months. It's an umbrella term for topics that should be considered when we're thinking about the whole of the value of a company. So if you're making decisions about a company, it covers things like the impact on the environment and the resources we're using, the waste that the company is discharging, the consequences upon the environment as a whole. It also covers things like the way that the organization manages their relationship with the society that it's interacting with. That covers upstream and downstream on its value chain. And it also is about the way that the company is thinking about how it is setting its strategy, how it is governing the way it is doing business. And it is a very useful way of reframing the way we think about a company's success and a company's failure, and also strategizing for how a company can develop its business model for the future. But I think one of the things that we just want to flag is that ESG is not actually in itself a reporting framework or reporting standard. And we see a lot of times that companies have released ESG reports or ESG updates. And these can often sound more like marketing exercises than they do a reporting framework or an actual report with substance. And this is a key risk for a lot of companies now, where regulators internationally are starting to stamp down and initiate legal action against companies who are using the term ESG as more of a marketing branding approach, as opposed to one where it is providing useful information to their investors and customers. So one of the difficulties in coming up with an ESG report of any kind is that there are so many different frameworks out there. It's sometimes referred to as what we call an alphabet soup of different reporting frameworks and reporting ideas. So as part of this, the ISSB, which is the International Sustainability Standards Board, was started with the intention that we needed to bring together all of these different multiple frameworks, and it was making it very difficult for investors to understand, what information was out there. It was almost impossible to compare reports between different companies. And so what they've tried to do is to release standards that bring together quite a number of pre-existing standards that were in the market. So we have the SASB, which was a US originally founded set of standards. We have Value Reporting Foundation, we have integrated reporting, the Climate Disclosure Standards Board, the TCFD, which you might have heard of, the Task Force on Climate-Related Financial Disclosures, and interoperability also with the GRI, the Global Reporting Initiative. And the ISSB, which sits under the IFRS Foundation, has released their two initial standards, the IFRS S1, which covers the general disclosures around sustainability-related risks and opportunities, and S2, which is specifically focused on climate-related disclosures. And the key goal of this is to essentially create a global baseline for the way that companies are reporting these ESG matters. I might just pause here if there's any questions from anyone in the audience. Okay, I'll keep going. So when we think about these IFRS standards that have just been released, I think one of the key things to think about is that even though many companies in the US are reporting under US GAAP, the IFRS sustainability disclosure standards have been developed to be accounting framework agnostic, which means that you can report under the IFRS sustainability disclosure standards even if you are a US GAAP reporting company. And that gives you the ability to have a clearly defined framework to follow to produce an ESG report, even if you are not applying IFRS accounting standards. So the way the standards are structured is that IFRS S1 gives you the overall principles of what S1 is trying to cover. And it also introduces 4 key pillars. And these 4 key pillars are the same 4 key pillars of disclosures that you see in the TCFD, the Task Force on Climate-Related Disclosures. And that was done, I guess, to recognize that many companies were already reporting in accordance with these 4 pillars. And so they have incorporated fully all of the previous disclosures required by the TCFD as part of the way they've built these new standards. S1, however, also brings in this sense of the concept of a sustainability-related risk and opportunity. And it asks that you disclose whatever you have identified as the company's sustainability-related risk and opportunity in accordance with those 4 pillars. It then layers on specific topic standards. And so the first topic standard that's been released by the ISSB is IFRS S2, which covers climate as its key focus. And so it specifies for climate, what are the specific disclosures you should make in terms of its governance, strategy, risk management, and metrics and targets. And the intention is that the ISSB will continue to be releasing topic standards in future, and those topic standards will continue to grow, I guess, the range of potential topics that you can be disclosing on. In the interim, while we don't have topic standards for specific areas, these can still be disclosed as part of your overall sustainability related risks and opportunities. So it doesn't prevent you from disclosing anything beyond that. So one of the key concepts of IFRS 1 is that you are only required to disclose material sustainability related financial information. And really what that's getting at is, are there aspects of the way that the company is operating where you are interacting with a sustainability related risk or a sustainability related opportunity that could potentially affect your future cash flows, your access to finance, your access to capital? Because IFRS S1 assumes that investors would be potentially interested in this information. And it just defines materiality in the sense of something is material if it might potentially change the economic decision-making of a user of your financial statements. And so the information that you're asked to disclose as part of IFRS S1 is very much around what are the sustainability related risks and opportunities that could potentially affect your business and potentially affect what a person wants to do in terms of the way they choose to invest or not invest in your company. And therefore, when you are making disclosures under these 4 pillars you can see on the screen, that is both quantitative and qualitative in nature. So thinking about how is the business running, how is the business developing their strategy to meet these risks and opportunities, but also more quantitatively, what would be the impact of this on the business? What would be the potential outcomes on what the balance sheet, what the cash flow statement might look like in future? When we think about IFRS S2, this is very much focused on the climate specific risks. So it asks you to disclose information about climate related risks, which it splits into two categories, physical risks and transition risks. And this will be familiar to anyone who's been working with the TCFD in the past. The physical risks are the things we think about in terms of what is the impact of climate change on our world. Is there going to be an increased risk of extreme heat, or a risk of flood, or a risk of hurricane, or any other kind of impact that might arise from the overall warming of the planet? The transition risks are in relation to, as the world comes together to deal with this issue of climate change, what are the impacts of transitioning to a decarbonized economy? What might be the regulatory risks or the legal risks or the reputational risks potentially arising from having to shift the way we do business in order to reduce the impact of global warming on the environment? Climate-related opportunities, on the other hand, are the things about where you might have an opportunity for your business. So you might be investing in a new way of doing something that is less carbon heavy, something that might be popular for consumers in future as they look for a new greener alternative to the way they're doing business. And those opportunities may arise across multiple areas of your business. Climate resilience is a piece around understanding how is your business going to respond to changes in future, and depending on the scenarios you might think of where the business will deal with changes like physical and transition risks, how well placed are you as a business to continue doing what you're currently doing, and what changes might be needed in order to help your business survive through the changes that might be coming? Now, that can be as detailed as full-on climate modeling with the assistance of a climate scientist to build specific modeling for your business, but it can also be as simple as purely hypothesizing in a room with the core people of your business to understand exactly what the business might look like. If this were to occur, what would happen? So if our energy costs went up by 15% because of the impact of carbon taxes, how would our business respond? There are also a series of required disclosures as part of IFRS S2. This slide summarizes for you the key disclosures that are required. And you'll note that the very first one there, greenhouse gas emissions, which gets a lot of media attention a lot of the time, it does require scope 1, 2, 3. So the SEC rule that was previously proposed last year, back in March, also had proposed scope 1 to 3, and I know there had been a lot of media attention around whether scope 3 was really viable. I know California just signed the bill this week to agree to requiring large Californian companies to do scope 1 to 3. But I also understand that there's a potential push out in terms of the timeline in relation to scope 3 for that. Scope 1 to 3 is really now starting to be required internationally, generally speaking. So it's required here in IFRS S2. It's also required in the European version of the sustainability standards, the ESRS. And so I think what we'll start to see internationally is a growing requirement for businesses to start disclosing their scope 1 to 3 greenhouse gas emissions. And this is really important because for the very large multinational businesses, scope 3 for them is essentially a lot of the time their supply chain and their customers. And so what we're starting to see is even in the smaller companies that might not be caught by the requirements to disclose under any of these regulatory requirements, they are now being asked as part of their tendering for contracts, can you provide us your greenhouse gas emissions? And so we're starting to see the trickle upstream and downstream into entities that might not necessarily be those very large entities who have already developed a way of calculating their greenhouse gas emissions, but potentially smaller ones in the mid-market who are being asked to, as part of being considered for tenders and opportunities, to track their own greenhouse gas emissions. And so I think what we'll start to see internationally is that greenhouse gas emission accounting is going to become more and more important because it is a necessary part of doing very large contracts and very large businesses internationally. And you'll also see the other requirements in there. The transition and physical risks, the climate opportunities and capital deployment to a certain extent are relatively easy to do because if you are thinking about these things as part of the business, you would already have that information. Internal carbon pricing is an interesting one because we are starting to see some jurisdictions internationally where carbon pricing is becoming a key part of the policy that's being implemented as part of different jurisdictions who are seeking to reduce the carbon emissions of a particular jurisdiction. For example, in Europe, you might have heard of the CBAM, the Carbon Border Adjustment Mechanism, which is essentially being brought in to apply an adjustment to the pricing of imported goods so that European Union companies who are subject to carbon pricing are not unfairly penalized for the price of their products versus the ones that they can achieve internationally. The other piece that can be quite sensitive is remuneration disclosures. And so, although if you are a publicly listed company and you are used to making remuneration related disclosures, disclosing exactly how much remuneration is tied to climate considerations may be particularly sensitive. And so that's another consideration for companies when they are thinking about what they need to disclose, being aware that if they're not used to disclosing that kind of information, that's also required under the standard. So when we think about the international impact of all of this, what you'll start to see is that we are seeing it move very rapidly. I am getting, information every 2-3 days. We actually had to update this presentation yesterday just for changes because of the fact that things are moving so rapidly in this space. There are new frameworks coming out, new guidance coming out pretty much on a weekly basis. And so what we will start to see is everyone is moving very rapidly. And because everyone's moving rapidly, they're not always aligned, but we are pushing for international alignment in all of the different structures that are being released. So if we look at just climate as an example, climate only, the TCFD, which I've mentioned a couple of times, occurred back in June 2017. The ISSB was formed in November 21, and the SEC disclosure rule consultation, the proposed SEC rule, came out in March of 22. The UK has already started mandatory climate disclosures. That started in April of 22. And in November of last year, the EU passed the CSRD. That's their piece of legislation that requires all companies that are either based in the EU or doing business in the EU above certain size thresholds to make sustainability related disclosures in their accounts. Here in Australia, Treasury had put out, our Treasury had put out the first consultation for requirements of climate related disclosures back in December. And then in January, New Zealand had commenced their mandatory climate related disclosures. The IFRS standards were released earlier this year in June. And at the same time, pretty much the second day, the Australian Treasury put out their second consultation. And that second consultation was actually vastly different to the very first one. So the Australian Treasury had originally suggested that we would be looking at only listed companies and only very large listed companies, whereas the version that was released on the 27th of June this year catches all companies that are required to report under the Corporations Act, which covers, in Australia, private companies, public unlisted companies, a great deal of other companies for which considerations of this kind were previously probably not considered. And that very much aligns to what the EU is doing in relation to the ESRS, where it is catching companies that are transacting in the area within the jurisdiction of the EU, and also catching non-EU parent companies of companies that are in the EU. California, as I've mentioned, has just recently passed a bill that requires very large Californian companies to make scope 1 to 3 disclosures, which is I suppose in comparison to what the EU, the UK, and Australia and New Zealand are doing at present, is probably smaller in scope than what we're seeing. But we would also expect that, as things gain momentum, that might change in future. In addition to what's on the screen, we also have Nigeria, China, Japan, Canada. A vast number of countries have made commitments to adopt the IFRS Sustainability Disclosure Standards in some form or another. So we are expecting to see more companies being caught by the requirement to disclose. So I mentioned the EU a couple of times. The Corporate Sustainability Reporting Directive, or the CSRD, is actually quite unusual in the sense that it not only catches the EU companies. So if you are an EU large undertaking is what it's referred to. So if you have total assets, annual revenues, or employees over the thresholds you can see on screen for 2 years in a row, that EU subsidiary is required to report under the ESRS, which is the European Sustainability Disclosure Statements. Those standards are much broader in scope than the IFRS Sustainability Disclosure Standards. The ESRS not only requires you to disclose on climate, but actually has 10 topics that need to be considered and assessed for materiality and for the impact on the world as to whether or not it is required to be disclosed. And so it's quite a significant exercise for companies that do have to comply with that. And the key piece for the CSRD is that if your company is doing any business in Europe, if you are a parent entity overseas, potentially, domiciled in the US or in Australia or in another country outside of the EU, but you have a subsidiary or significant operations that meet the thresholds you can see at the top of the screen, you will also be required to make disclosures from 2028 if your EU revenues were over 150 million euro. So where you might think that you're safe from the ESRS because you are not an EU-based entity, the parent entity may need to make disclosures, and those disclosures would cover the full global consolidated group. So it is a very significant impact, not only for EU companies, but non-EU companies as well. And this is just a sense of the timeline of the CSRD. So there are some entities within the EU that are already subject to the non-financial reporting directive. And for those companies, they would be required to report under the ESRS from 2025. But really, we're thinking the FY25 to 28 ones, which will be reporting in the year post that financial year, so 2026, 27, and 29. Those are the companies that are more likely to be significantly impacted by this because it is a brand new type of disclosure for those companies in many cases. In Australia, we have a number of things that have been happening. I mentioned earlier that the Treasury proposal had changed their position on these disclosures significantly between the first and the second consultation. You can see on screen here what the second consultation position was, and that is that all companies reporting under Chapter 2 of the Corporations Act, which includes your private and public unlisted companies, subject to these thresholds you could see on screen, would be required to report. It's important to note that Group 3 there is actually the reporting threshold for all companies that file any sort of financial accounts with ASIC. And so that essentially means every company in Australia that is required to have an audit under the Corporations Act would also be required to make these disclosures. There is additional requirements there for ENGA reporters. For those not from Australia, ENGA is the Australian National Greenhouse Gas and Energy Reporting Framework that is essentially any significant emitters or large emitters in Australia are already required to make disclosures in relation to their greenhouse gas emissions. And they would be caught by this even if they were below the size thresholds as well. So this is just summarizing which entities are caught by Chapter 2M. In Australia, unlike some other parts of the world, the majority of companies in Australia would be required to make some kind of financial statement report. So disclosing entities, public companies, large proprietary companies, registered schemes, superannuation entities, which is superannuation is our form of kind of like a 401k or a pension style fund. Not included by it would be anyone who is a small proprietary company, so below the thresholds that you saw on the previous screen, small companies that are limited by guarantee, which tends to be very small NFP organizations, financial services license holders who don't otherwise need to report other than the fact that they have a financial services license, and ACNC, which is our charities register. Those organizations are essentially technically caught by the Corporations Act, but Chapter 2M of the Corporations Act is so-called turned off for those entities, and so they wouldn't be caught. However, we know that there are many NFP organizations that are also thinking about similar reporting, even if they're not required to by the Corporations Act. And a lot of times that's coming from expectations from society, from their stakeholders. And for government organisations, the Australian government is introducing their own requirements specific to government sector entities here in Australia. I think the other thing just to note is that the requirements in Australia is also proposed that there will be assurance associated with that. And so we are expecting that from 2025, there will either be reasonable or limited assurance, depending on the different types of disclosures required. And so this is a significant change for the Australian market, which has never previously had anything in relation to this required. And audit firms across the country are very concerned about how they are going to upskill rapidly enough to meet this regulatory requirement. I will just go now to some final thoughts around this, because one of the things we have noticed as we are assisting clients in this space is that the preparation of the sustainability related report is really the final aspect of what you need to think about when it comes to sustainability reporting. The sustainability report is essentially the outcome of a lot of thinking that has to happen in a company before they can produce a report of this kind. There is a number of scoping decisions that need to be made by the company that consider how the company is relating to sustainability related risks and opportunities in their business, how that affects them, whether they are material or not to the way the company is doing their business, whether they are material to the way that they will change the way they interact with their suppliers, with their customers, with the types of work that they do and don't accept. And then incorporation of all of those risks into the way that the entity is governing all of their risks as a whole. So how it is being integrated into your normal business as usual risks, how that you're affecting that in your strategy. All of that thinking has to occur before you can start making disclosures in relation to governance strategy or risk management. And then when it comes to metrics and targets, the importance of identifying a metric or a target that is relevant to your business can take quite a lot of discussion and can take quite a lot of time. And then the process of from there being able to collect and process the data that's needed in order to progress towards a financial report and having these sustainability disclosures integrated into the financial report is a very significant exercise in itself. It's often dealing with non-financial information, which is not something that the accounting systems and kind of all the internal controls of an entity have been built to track and to trace and to layer on internal controls for it. And so you are essentially building an entire new processes and controls, an internal controls framework, you might say, for the purpose of collecting this sustainability related data. And at the very end of it, once you have prepared your report, making sure that you're assurance ready and that you've got the documentation and everything in place ready to be audited in the same way that you would if you were doing a financial statement audit is again another exercise, and it takes a significant amount of time. But the key thing to remember, I think, is that as finance professionals, we're often the best placed within the company to guide that process because we understand how information gets tracked. We understand the importance of being able to identify the data flows, to build the controls and processes in place to make sure that the data that's coming out of this report is verifiable and auditable. However, it does require a lot of collaboration with other parts of the business that you might not necessarily be talking to on a day-to-day basis to understand how operationally these sustainability-related risks and opportunities are affecting the entity. So I might just pause there for any questions.
I think, excuse me, you have one question in the Q&A. I don't know if you see that.
I can't see it at present. Could someone read the question out for me?
Kathy, you want to go ahead and read your question? She says, what are the changes that climate change denier companies will greenwash their disclosures?
Sorry, could you repeat the question? What are the...
Sorry, I'm a little hoarse. Been doing too much talking today already. What are the changes that climate change denier, DENIER companies will greenwash their disclosures?
So greenwashing is a very significant focus area for a lot of regulators at present. For those who aren't familiar with the term, greenwashing is the idea of making something sound like you're doing something important, essentially using green sounding terms to make things sound like you're doing something important when you're not actually. I think the key risk, and this is a different risk depending on where you are in the world, but in Australia in particular, any disclosures that are made by a company in their annual report are subject to the Corporations Act requirements. And the key risk for directors is that the directors' duties in Australia require that every forward-looking piece of information must be supportable, reasonable and supportable basis. And so in Australia, there is no safe harbor for any disclosures made of that kind where you do not have a reasonable and supportable basis. And our local regulator, ASIC, is prosecuting a lot of companies in relation to these so-called greenwashing claims because of the fact that a lot of what we talk about in terms of climate and climate-related risk is forward-looking. And it's almost impossible to have a claim made in relation to climate-related risks and opportunities without having a forward-looking element to it. So in Australia, the greenwashing risk is very real because we don't have any kind of safe harbor provision for directors. If you are a climate denier, I think was the phrase that was used in the question. Companies that are in that position, if they are caught by the requirements to make disclosures, would still need to disclose the fact that they do not believe in potentially that there are any climate-related risks or opportunities for the business. I would caution those companies that that would not be a position that I think the local regulators would take particularly well. Very much the nature of what we are starting to see in the market, the expectations of many people is that it is almost impossible to say that a business would not have any potential climate-related risk or opportunity. In the same way that even if a company would like to think that they have no greenhouse gas footprint, the fact that any company uses energy, if you use electricity, you have a carbon footprint. Under the greenhouse gas accounting standards. And so it's very difficult for any company to say that there's actually no climate-related risks and opportunities because aspects of the standard, such as the requirement to disclose your scope 1 to 3, are near impossible to say that you have no carbon footprint whatsoever unless you're completely off the grid, completely generating your own energy without any use of purchased services or goods, without any supplier chains, without any supply chains. And that's a very difficult statement to make.
Matthew has got a couple of questions. Matthew, you want to come off mute and share your questions with us?
Sure. Just a little more of a, I guess, a nitty-gritty question, which is
Mhm.
as an auditor or assurance, sorry, I'm from US.
Yeah.
You probably have some expectations about how much additional cost of the compliance might cost to the company.
Mhm.
I'm a former CFO, so
Yeah.
I think I'm sensitive to that additional
Mhm.
cost aspect.
Mhm.
Um, it could be either additional human resource that's required, or as well as the additional cost to the auditing firms.
Mhm.
I'm sure they're double. The number two is I don't want to be flip, but what are some of the current penalties for non-compliance or audit failure?
Sure.
Because the standards are moving, and
Mhm.
even if the intention is to fully comply, I'm sure there will be some issues. So I'm just
Sure.
curious about the penalties. Thank you.
For sure. I'll do the first one first, which is in relation to the additional compliance costs and the additional costs of all of this. And it's true, there is going to be additional compliance costs, both internally and from your audit providers in relation to this. I hesitate to say too much in this space purely because the proposed new international assurance standard in order to guide auditors through auditing this is ISA 5000, and that was only released couple of months ago and is still only in its first exposure draft stage. And so we don't know precisely what the final standard's going to look like after the consultation period and after changes are incorporated. But based on the current ISA 5000 exposure draft, the person that is providing the ESG opinion in relation to the ESG disclosures would need to work in tandem with the financial statement auditor, so whoever the lead audit partner was on the audit itself. And they would be required to provide an opinion if it was reasonable assurance, or if it's a limited assurance piece, do the necessary procedures for a review over many aspects of that ESG disclosures, both the qualitative and the quantitative. And so I would expect that in a situation where in Australia we're proposing by the fourth year of adoption, all companies would have reasonable assurance over all aspects of their climate-related disclosures, we would expect that there would be a significant increase in the compliance burden on companies as a result. We would like to see how the Australian government is going to respond to that. And we are expecting them to make an announcement this month to clarify their final position in relation to all of this. And so we're sort of all waiting to see what will happen, because we do expect that this month that will be released, along with the Australian version of the IFRS Sustainability Standard will be released this month. So it's sort of a wait and see in that approach. In relation to the risks and penalties, because all of this legislation is currently being drafted or is in very early stage of implementation, although there are penalties drafted into the legislation and penalties that it obviously give the regulator the ability to pursue companies in relation to this, it's so new that we don't really have any case law examples of it being prosecuted as yet. And so it is difficult to say what will happen in that space. But certainly we know that in the same way that regulators can pursue companies for failing to lodge financial statements in accordance with the Corporations Act, or failing to follow accounting standards, those types of penalties, which may include court action, which may include fines of various sizes, are able to be pursued and have done so in the past. I guess the other element is we know that audit firms themselves are subject to scrutiny from the regulators. And certainly we've seen over the last couple of years that there's been a lot of activity in that space, as the expectations of what an auditor firm needs to provide in relation to, lifting the standard of audit quality has been a key focus for regulators. And we are seeing that as potentially another risk. As these requirements come in, we expect that might also be incorporated incorporated into the scope of what that would occur. So I think what we'll see is, we don't know yet, to answer your question, Matthew, but we would expect it to be incorporated into the pre-existing regulatory environment for all of this.
Okay, thank you.
Any other questions?
Yeah, I have kind of a question for you. I
Sure.
do a lot of M&A work. I have clients and we buy companies, and we have pretty much put ESG right at the top of our list when we start our due diligence. One of the things that that's become very important is if you bring in a private equity investor, which we have a lot here. ESG is becoming an important element for them in measuring the worth of a company as well as the management. For your private equity firms there, how important do they see ESG measurement when it comes to doing a due diligence on a company?
I would say it's become more and more important as time has gone on. I think because there are, for example, many funds out there who have now built ESG as part of their investment opportunities and said, you know, like, this fund is focused specifically on ESG opportunities. We've seen a lot of that come out of BlackRock, Blackstone. A lot of the large PE firms have similar funds out there. In addition, what we start to see now is, because a lot of these significant PE firms are likely to be caught by these required disclosures, there's a specific disclosure requirement for anyone who is in that space to make specific disclosures around the emissions in relation to their investments. And so we're starting to see that investment companies, banks, credit unions, PE firms who are required to disclose specifically in relation to that, they're building that in as part of their considerations, because they know they'll need to make disclosures in relation to that as well.
The question related to greenwashing actually kind of like hit a little bit of a nerve with me, because some of the firms I've seen over the last done due diligence on the last couple of years, they're just, let's just throw the terminology on the paper and then let's just hope it sticks and let's just move on. And and it's incredible. People were not taking this serious about 2 years ago, and now it's taken the regulators to basically, like the SEC, the FTC, and et cetera, have really stepped up to the plate and made it a necessity. So I'll shut up now and let you go on with your presentation. Thank you.
No, that's all good. I actually wanted to leave it open for any further questions, because really from here it's whatever you would like to discuss in relation to these things. It is I would like to make this as relevant as possible to the people attending, because there are so many different ways that this presentation could go. So are there any key areas that we would like to discuss?
I'll just bring up one, that's carbon pricing. That's one of the things that shall we say is easily interpretive as to how to go about it. Through your experience, are you seeing a commonality in doing carbon pricing in an appropriate manner that actually makes sense and is realistic, or is it just kind of like the dreams and wishes of the management of the companies?
I think it depends very much in which jurisdiction the company is operating in. And the reason for that is that carbon credits or carbon offsets or other similar carbon credit style arrangements exist in multiple jurisdictions, and the rules around those differ jurisdiction to jurisdiction. And so where we're seeing companies very focused on carbon pricing internally, it tends to be where they know they may have a requirement to offset their emissions by regulation or by proposed regulation. And so they are building in the cost of either reducing those emissions or having to purchase carbon credits in the market in order to reduce their overall net emissions as part of their considerations. For example, in Australia, the Australian Carbon Credit Unit, which is the ACCU, our version of a carbon credit, the market for that is formally going to open in the coming 12 months or so. But there are, of course, very many other alternatives to the ACCU out there in the market. And the voluntary carbon market has had significant growth in the last couple of years and has pretty much grown so significantly that I think it's there's a lot of discussion in the media around, you know, is it reliable? Is it useful? But it does provide companies with a starting point, at least, to think about how they might price carbon. To be honest, a carbon pricing mechanism is something that needs to start first with their carbon accounting inventory. So when you first start with that carbon accounting process, a lot of firms start to think about the carbon pricing as part of that, because in the process of working through calculating their scope 1 to 3 emissions, they start to understand where the differences can arise and how they might be building that into their future plans about, for example, should we go with this supplier or that supplier based on what the impact will be on our carbon calculations. And that's where we start to see the thinking necessary behind a carbon pricing internally start to come into play.
So let's say you have a company that's just starting out and it wants, you know, it needs to start gathering this information. How would you recommend that somebody start doing this from scratch?
From scratch, I think it starts with a really good understanding of the business. And in a startup-y kind of situation that you're describing, chances are there's probably a pretty small number of individuals that really get the business inside out. And so that would be the place to start, to understand, you know, what does our business do? What are the key areas of our business that really drive our cost base, that drive our interactions with customers and consumers? And quite a lot of times we see companies who are in that, say, you know, tech startup space underestimate their carbon emissions because they think of the internet as being something like, you know, oh, it's the internet, like it's not like a pollutant factory or something like that. But I think shifting the mindset to go, well, actually the internet uses a significant amount of energy. You're using data centers across the world, and the cooling that's required to keep those data centers going has a carbon footprint. There was a study a couple of years ago that suggested that the internet globally might have the same carbon footprint as the aviation industry. It was a single study only, but that I think shocked quite a few people to think that actually the aviation industry and the internet were potentially comparable. And so when they start doing the scope 1 emissions for a company that's a startup are probably pretty small unless they're doing significant manufacturing. The scope 2, your use of electricity, fuel, heating, cooling, purchased like that, that's usually pretty easy to obtain the information because it's probably on your utilities bills, and you can access that information pretty easily. Depending on where you are in the world, that may give you additional information about how green the energy that you're purchasing is or not, but it gives you a starting point as a base. Then to think about your scope 3, I normally would suggest that a company starts with what are your purchase goods and services, because again, a lot of that information is going to come initially from your financial information and go, well, what are we spending our money on? And that provides a good starting point to think about, of the things we're spending our money on, what might be the potential carbon impact of that, and starting upstream there. Then thinking about employees. If it's a startup, they probably don't have a significant amount of employees, but as your employee base grows, to think about, you know, if they're working from home, well, that's also a carbon footprint, because even if they're not working and commuting to and from the office, there's a carbon footprint associated with them using electricity in their own home office. And then thinking about what's our product and what are we selling to consumers? How are they consuming our product? And what might be the carbon impact of that going forward? So I would start small, start with the data that you have, and probably don't be disappointed by your very first carbon calculation. We find a lot of companies are very disappointed when they first do their carbon calculations, because they go, oh, it's not as good as I was hoping. Yeah. And part of that might be a lack of data, because the accuracy of your carbon calculation is very much dependent on what data you have available to you. But another part of that is understanding actually your activities are much broader than you might expect, particularly once you consider the supply chain.
Yeah, the reaction I usually get is, this can't be right. are you sure it can't be right? Which is always fun. It's funny you mentioned the internet because you may or may not be aware that, cryptocurrency, all the computers and that were housed in China. Now China's realized, oh my heck, that's a lot of energy. So they're now pushing it offshore, and they've done a lot here in the US to rebuild the center just for that. And a lot of people are not happy simply because it's just not fitting in with the ESG profile. And so there's a lot of discussion about what are we going to do now. So because you can't run these things off of solar energy, it's got to be constant. So,
it's got to be constant. Yes.
So sell your Bitcoin now.
It is one of those things where I think people have suddenly realized that even though you thought it was digital and therefore it was a more efficient way of doing things, it is not necessarily as clean as you thought.
Yes, true. Does anybody else have any more questions? Well, I think we're good. Great job. Really appreciate you doing that. We didn't need that other guy or whatever his name is.
All good. I've just got there my contact details if anyone would like to chat further. We're happy to have a chat. But otherwise, thank you very much for having me.
Well, we sure appreciate it.
I want to
Thank
thank
you.
Rodney for being my pro tem chairperson today, and Samantha, really interesting presentation. So thank you so much, and have a good day.
Have a great day or a great evening. Thank you very much, everyone.
Appreciate it.
Thanks.